Crypto feels broken right now. Prices are down, headlines are ugly. But here's the uncomfortable truth. Crypto is not going away, and actually it quietly integrates itself into the financial system. Not replaces it, integrates into it. And most investors miss that moment because they are too focused on the Bitcoin price chart. Today, crypto and traditional finance are no longer enemies. They are merging, slowly, structurally, and that matters more than whether Bitcoin is up or down this month. In this video, I'll show you why the merging of crypto and traditional finance is accelerating right now, and we'll go through 7 publicly traded stocks that give you direct exposure to this shift without having to speculate on random tokens. This is not about hype, it is about payments, custody, infrastructure, the boring parts that actually survive. I'm Daniel, a former London stockbroker and worked in finance for 10 plus years. I also publish stock market analysis to numerous investing websites, and in addition, I host one of the largest investor conferences every single year in Central Europe. And if you want to see more videos like this, hit that subscribe button. Let's start with the big picture, because without it, none of the individual companies make any sense at all. For most of its life, crypto existed outside the financial system. No regulation, no clear rules, no serious institutional trust. That worked when crypto was small. It does not work when pension funds, banks, payment networks want in. And that's exactly what changed the United States over the last 2 years, and also changing all around the world. The approval of US-listed Bitcoin and Ethereum ETFs was not just a product launch, it was a political signal. It told banks, asset managers and corporates that crypto is no longer a grey zone experiment. It is regulated asset class that can sit inside brokerage accounts, retirement portfolios and balance sheets. Maybe retirement portfolios are not that brave just yet, but sooner or later 2 to 3% of retirement portfolios will be allocated into crypto. At the same time, US legislation around stablecoins, custody and market structure is moving forward. Slowly and imperfectly, but clearly one direction. Integration, not prohibition. And once regulation shows up, traditional finance follows. Not because it loves innovation, but because it loves fees. This is where merge happens. Crypto brings new layers, faster settlement, programmable money, global transfer without intermediaries. Traditional finance brings trust, scale and regulation. The result is not a crypto takeover, it's a sort of hybrid system. Now let's talk about the companies building that hybrid layer, starting with one most people completely misunderstand. Circle Internet Group. Circle is the company behind USDC, one of the largest stablecoins in the world. And to understand why Circle matters, you need to understand what a stablecoin actually is. A stablecoin is not an investment. It's not designed to go up. 1 USDC is meant to always equal $1. The value comes from what it allows you to do. Instantly move dollar value globally 24/7 without using banks as intermediaries. Under the hood, USDC is backed by short-term US government bonds and cash equivalents. When someone uses USDC, they are effectively using a digital representation of the dollar, but on blockchain rails. This matters because stablecoins are becoming settlement tools, not for speculation, for payments, for treasury management, for cross-border transfers. The company also has EuroC, the euro version of the stablecoin, backed by, obviously, the euro. It's also used for payments and not speculation. Which brings us directly to Visa. I'm sure you are currently using a bank card that is issued by either Visa or MasterCard. However, Visa is not a crypto company, and that's exactly why it matters here. Visa recently launched a stablecoin settlement in the United States, allowing certain transactions to be settled directly in USDC. This is a big deal not because consumers will notice, but because it changes how money moves behind the scenes. Imagine a global merchant getting paid in stablecoins, settled instantly, instead of waiting days for traditional bank clearing. Lower costs, faster settlement, less counterparty risk. Visa does not care whether the rail is crypto or traditional. It cares about volume, and stablecoin definitely increases that volume. Now let's move to Coinbase, probably the most obvious name on this list, but also one of the most misunderstood. Coinbase is often treated like a leveraged bet on crypto prices. When prices go up, Coinbase goes up. When prices fall, the stock gets punished. That's the surface level view. The deeper view is that Coinbase is infrastructure, a custodian, a trading venue. You've probably already heard about this company or actually used it as crypto exchange, bought or sold some crypto on it. But lately, Coinbase is not only for you and me anymore, it started to become a service provider for institutions. As crypto ETF launched, some had to custody the underlying assets. Coinbase does a lot of that. As institutions enter, they don't want to self-custody. They want regulated partners. And Coinbase sits right in that gap. So if you buy a Bitcoin ETF on your traditional brokerage account, the Bitcoin may be parked at Coinbase. Over time, Coinbase looks less like a speculative exchange and more like a crypto version of financial services platform. Lower margins, more stability, more regulation, less excitement, which is exactly how systems mature. Now let's talk about custody, because this is where traditional finance really starts paying attention. BitGo. BitGo is a digital asset custodian. Think of it as a specialized vault for crypto assets. It provides secure storage, multi-signature wallets, insurance, and compliance tools for institutions. Let's say that if you're a hedge fund, ETF issuer, or corporate holding crypto on your balance sheet, you definitely don't want to manage private keys yourself. You want someone else to take that risk. BitGo exists because crypto ownership without institutional-grade custody does not scale. This is the same traditional role custodians play in equities and bonds, just different assets, but the function is literally the same. Next is Bullish. Bullish is a crypto exchange backed by serious institutional capital, including Peter Thiel. It is focused not on retail trading hype, deep liquidity, compliance, and institutional-grade trading infrastructure. Bullish represents the professionalism of crypto markets, less meme trading and sort of things, more structured liquidity, more similarity to traditional exchanges actually. They also provide news on crypto. If you ever used Coindesk.com to read, let's say, the latest news, you have used Bullish, because this website is also part of the whole Bullish network. Now let's move to the company that made this entire conversation unavoidable for equity investors. MicroStrategy, new name Strategy. MicroStrategy is not a crypto company by its business model. It's a software company. But it became the largest corporate holder of Bitcoin as a strategic treasury asset. Effectively, MicroStrategy turned itself into a publicly traded sort of Bitcoin proxy. When Bitcoin moves, MicroStrategy amplifies it because of leverage and accounting structure. This is high risk, really high volatility as well, and very intentional. MicroStrategy matters because it forced traditional investors to come from crypto inside equity markets. You don't need a wallet, you don't need an exchange account. You just buy the MSTR stock and then you are relating to crypto. Let's talk about interactive brokers, because this is where things get quietly interesting for everyday investors. You probably heard about interactive brokers. It is a global brokerage platform. It has stocks, ETFs, options, futures, and increasingly crypto. But here's the key part. You can deposit stablecoins into interactive brokers. Now, in America, Europe is following. Why does that matter? Because stablecoins settle faster than traditional bank transfers. They don't rely on banking hours. They don't bounce between correspondent banks. For international investors, this can mean faster funding, lower friction, and more flexibility. Let me give you an example. Let's say you want to deposit $10,000 into your account. Normally, it would take a couple of days to arrive from Europe to the US. And you will also pay $5, $10, $15 fee depending on your bank. With USDC deposit, The money arrives instantly with no transaction fees. Over time, stablecoins can act like a parallel cash layer inside brokerage accounts, not replacing banks but complementing them. And this is the pattern you should notice. None of these companies are betting on crypto replacing the financial system. They are betting on crypto becoming part of it. Prices will go up and down, tokens, new crypto will come and go, but infrastructure sticks. The long-term opportunity here is not guessing the next meme coin. It's understanding where traditional finance is quietly adapting because it has no other choice. Regulation is forcing clarity. ETFs are focusing on institutional participation. Stablecoins are forcing efficiency. And publicly traded companies are building the bridge. The market hates uncertainty, that's for sure. And right now, crypto prices reflect exhaustion and doubt. But structurally, the system is becoming more embedded, not less. For long-term investors, especially in Europe, the question is not whether crypto survives. It's how exposed you want to be to the companies building the rails. If you want to understand how to position for that shift without chasing hype, stay with this channel, subscribe to the channel, and don't forget to hit the like button to help the YouTube algorithm. See you next time.